The Dentalpreneur Podcast. Okay, doctor, it's time to put down that handpiece. You're listening to the show dedicated to helping dentists get their lives back. It's time to decrease your stress, increase your profitability, and regain your passion. Now introducing your host, Dr. Mark Costas.
Hello, everyone. Welcome to another episode of the Dentalpreneur Podcast. I'm your host, Dr. Mark Costas. Hey, friends. How are you doing today? I hope you are awesome. I am spending the afternoon with you and two good friends that I've known for many, many years. These guys have had my back for a lot of years. You guys have heard them on the podcast before. We have some new topics that we want to cover today. Let's welcome back to the podcast the co-founders of Profi 2020 and Phase 1. We have Brent Saunier and Chris Sands. Gentlemen, welcome back.
Great to see you again, Mark.
Thank you, Mark. Good to see you.
How are you?
We are in the thick of it, heading into tax season right now. So it's late February, and got all the tax organizers out, starting to have documents trickle in, and everybody's batting down the hatches.
Yep. It's funny because you guys were 4 minutes late, which is never the case on the podcast. And I was like, you know what? It is almost March. I bet these guys are up to their eyeballs in paperwork and emails. But yeah, thanks for making the time today, guys. I really, really appreciate it. First and foremost, I think it's worth noting that Brent and Chris have been with me for, I want to say 5 or 6 years now. It's 2018, I think, Brent.
Correct.
When you took over.
Gosh, that's 8 years.
Yeah, it's crazy. And so much has happened with my businesses and my life in that period of time. The reason that I brought Brent on in the first place as a CPA was because my level of sophistication and the number of entities that I had just got a little bit overwhelming for my existing kind of hometown CPA. And boy, did it prove to be the right decision, especially during COVID when these guys were hopping on webinars left and right with us, helping us navigate kind of the PPP stuff and all of the legalities and entity formation and stuff that people were going through, furloughing employees and stuff during COVID. But the biggest benefit has been just the overall organization and the ability to take a look at kind of the whole tax picture for me. Instead of being reactive, we're much more proactive. In fact, we start talking like in December about the upcoming tax year. And it's just giving me a whole bunch of security and sanity when there was none previously. Secondarily, Brent and I got to know each other really, really well because we went through a 3-year period where they were auditing 2 years of my federal tax returns, 2018 and 2019. So I learned a ton. Brent was kind of a stabilizing and calming factor in my life at the time because there's nothing more scary than the IRS saying that you owe $1.2 million in back taxes. And they act a lot like a credit agency where they just kind of hammer you with threatening emails and physical letters. And, a federal tax return is just as scary as you think it would be. It's ranked right up there with some of the greatest fears that people have, especially business owners, and justifiably so. It can be very, very scary, but particularly scary if you don't have good representation. So Brent and I and my team and your team over there at Profi successfully navigated the 2-year audit over a 3-year period of time and came out relatively unscathed. I mean, like it went from a 7-figure demand to a low, 5-figure demand.
5-figure.
Yeah.
I think that initial bill was $2.3 million, by the way.
Oh, really? See?
Well, higher than 1.2.
Yeah, it was 1.2 for 1 year. Yeah. And then, yes, it was a scary, scary time, man. It's like, I don't have $2.3 million sitting in my couch cushions. So
not the most fun way to learn, but probably the most memorable.
Yeah. And we've done several episodes kind of reflecting on what both of us learned during that situation and some of the things that I would do differently in the future. But the main thing that I think saved us was that I just have a really good team, and we were able to kind of put stuff together, find pretty much every receipt that they were looking for. We have a much different tracking system now for all of our receipts and all of our business expenses. So that has definitely tightened up quite a bit since those years. And one of the years that we got audited was a year that I was with my previous CPA, and things were particularly messy then. So that's kind of some of the history that I have with Profi. One of the cool things that you guys are doing now is Profi was, and please correct me if I'm wrong, but the way that I understood Profi to be was it was for larger practices, businesses that had multiple entities, multiple locations, larger production, larger teams, more sophisticated kind of case studies and financial scenarios. So you guys weren't really touching the kind of startup practices and the practices that were less than like $1 million to $1.5 million. So you guys have now founded another company called Phase One, where you guys are now working with that segment of the dental population, the newer practice owners and the smaller practices. So it's kind of an all-in-one, all-inclusive accountancy now.
Hit cut. That's the commercial right there. You couldn't have said it any better, Mark. That's exactly right. And we're excited. It's been pretty invigorating. I would say so we started this back in June, mid-year of 2025. Mm-hmm. And so for the last 7 or 8 months now, it's been exciting to dive back in with the young dental entrepreneurs. We've learned a whole lot. Brent and I went through a designation last year, certified exit planning advisor designation, and it really made us look at, the journey, the business journey, the entrepreneurial journey of every client, thinking of, beginning with the end in mind, and exit planning not being an event, but more of a just good business strategy in general. And having that conversation on the front end with somebody who's doing a startup or buying their first practice and just kind of getting started out slowly and on the small scale, there's a lot of, I think we've come to determine that there's a lot of value packed in those early conversations that we just haven't been having. We've been missing out on because we're usually inheriting somebody's established business with all the legacy stuff that comes with it. So both models have been rewarding and fun for us, but this one I think has gotten us excited, gotten our team excited.
Yeah.
As well. There's a lot more energy. That's what I could say.
That's cool. So I would say that like there's probably, when I work with startups and what we call baby docs, so you guys are kind of a cradle to grave, for lack of a better term, kind of accountancy now. We try to be that. I mean, I start talking to D3s and D4s. I spend a good portion of my travel time going to dental schools, and I was just at the ASDA Western Regional event for about 400 dental students there in Las Vegas in January. So, I try to kind of influence as much as I can through teaching through kind of some of the mistakes that I've made. And that's been the biggest classroom for me. I have a master's degree in mistakes and failures and setbacks. So I feel like I'm qualified to help people navigate some of the big obstacles that I ran into. So now that you guys have this like depth of understanding of some of the larger practices and the most common mistakes that the larger practices make, what are you guys seeing as some common themes for some of the new startups that they're making? Because there are some missteps that you can make right off the bat that will kind of follow you for years to come if you don't do it right in the beginning.
Yeah, and I think, just to add on to what Chris said real quick first, hearing all these older doctors, when they come to us and we start educating them, the constant theme is, I wish I had known this 20 years ago. I wish I had known this 30 years ago. So that really kind of set the light bulb off for us. But, well, why don't we provide that education and start working with the startups? Mm-hmm. And this is really going back to basics, Mark, because, one of the first things the doctor has to decide is what type of entity are they going to create and run their dental practice out of. And if you think about these younger doctors, I mean, they've got probably their classmates in their ear, maybe some other doctors they're friends with. They've got maybe some advisors saying, "Oh, just be an S corp." But so we want to kind of give some education on entities from a legal perspective, although we're not attorneys, and then how that parlays into how the IRS looks at it.
Mm-hmm.
So the most common things that you'll hear are LLCs or limited liability companies.
Mm-hmm.
You'll hear about PLLCs, professional limited liability companies. Those are legal terms, and those are dictated by state law.
Okay.
So the IRS does not tax you based on the name of your entity, like LLC or PLLC. They tax you based upon how you elect to be taxed.
Mm-hmm.
So, for example, an LLC, which I know you have, could be taxed as a sole proprietorship,
Mm-hmm.
which was your specific situation in the past,
Mm-hmm.
or you can make an election to be taxed as an S corporation.
Mm-hmm.
And I would say the biggest thing that we see is people are making that judgment call without any education on what it really means.
Yes.
And when you make decisions, I think it's important. You need to not only look at today's fact pattern, but you also need to think out 3 to 5 years. Where do I want to be? What type of practice am I trying to build? Because all of those factors really go into my recommendation on what entity type to set up. So, for example, if I had a doctor come to me and say, "Hey, I'm starting up a new practice." Well, one of my first questions is, what does that look like in 3 or 5 years? Are you going to have a partner? Are you bringing associates to giving them equity? Because in that situation, I would make a different recommendation than if they were potentially going to be a solo owner for the rest of their career. So you've really got to look out and kind of talk to the doctor and find out what their goals and really what their plan is and help advise them on the best structure.
What is the issue or the consequence of selecting an S corp too early or at the inappropriate time?
So I think that's one of the biggest, hottest things going on right now is there's a lot of blanket advice across the internet, across YouTube videos. And even you have to ask if you're using ChatGPT, you have to ask the right question in the right way, the right context. Mm-hmm. So I literally dealt with this morning with a young lady who was buying a small practice in the state of Florida. She was using ChatGPT and asking, what's the best entity type or entity filing. She was not using an attorney to register her entity. She tried to do it herself with the Florida Secretary of State. Mm-hmm. Filed an LLC. Then was introduced by the lender to an attorney. The attorney told her, no, that needs to be a PLLC. So he had to help her, expedite getting that changed before it was fully registered. And then he also stepped in and caused some confusion. As an accounting firm, we don't give any legal advice. And usually there's a disclaimer even from the attorney that says, I'm not giving tax advice. Mm-hmm. But he said, you need to be an S corp and I'll help you file that as well. And so she comes to the call with this information and I'm like, pump the brakes. See if you can get him to stop that filing, or, we may have to reverse it. That's going to be a pain. And so she asked why. And as I'm talking to her, she's retyping into ChatGPT, what is the best for a startup business, LLC, S corp, and she's validating some of the information I'm giving her. What I want you to hear from the source, from the CPA, is the difference in the entity filings in terms of tax basis. There are different types of tax basis. There's stock basis in an S corp. There's potentially debt basis in an LLC. And any startup, in most cases, unless you're bringing your own personal cash, you're taking out loans. And there are upfront deductions with the assets. If there's any equipment purchased, in this case, this was like an empty turnkey office where she gets to purchase it with all of its equipment. She'll get some asset deductions. I think there are some patient files she's getting, and it's there'll be some goodwill as well. But those upfront deductions, everyone kind of understands they want to take those upfront, what they don't understand is if they make this wrong entity election, this filing election incorrectly, they can trap those losses and not access them. So that's really the crux of the matter here. And it's happening over and over again where people are getting it to us as their second accounting relationship, or they've been going with no accountant from the onset. They've been operating, they've got all this going, and they're like, okay, now, account for it all, put it together and apply my deductions, and then we go, uh-oh, problem. So Brent, why don't you fill in the gaps there?
Yeah, so Mark, I know you and I, we talked extensively over the years when we were talking about doing some entity restructuring for you. So the S corporation, typically speaking, long-term is a good option for a solo doctor because there are some tax savings opportunities from the payroll tax perspective. But in the early years, as Chris said, when you make the initial purchase, you want to accelerate the depreciation expense on the assets you're buying. With the S corporation, unless you're putting personal money into that entity, those losses are going to get trapped, and you won't be able to deduct them until maybe 1, 2, 3 years later when your practice becomes profitable.
Okay.
So let me give you an example. So let's say that a doctor was deciding between a sole proprietorship versus an S corp.
Okay.
Let's say they didn't get the good advice and they went ahead and made the S corporation election.
Okay.
So let's say that they ended up taking a $600,000 loan from the bank. Let's say they injected $40,000 of their personal money into that entity on day one. So fast forward 12 months, they want to write out the equipment and they generate a $150,000 loss on paper on your profit and loss statement.
Okay.
In an S corporation, they are limited to only deducting $40,000 in year one, the personal money they injected into that entity. Whereas if
is that a set number, or is that some percentage of their AGI?
It's based on the amount of personal cash injections in an S corporation. Because as we talked about, personally injecting cash is one of the two main ways that you generate stock basis in the S corp.
Okay.
The other way, the most powerful way, is generating profits. So now you've got a doctor who thought they were going to file their tax return with 150,000 of losses, but the CPA has to tell them, well, you can only deduct 40 this year. It's a very uncomfortable conversation.
Yeah.
On the flip side, if they had gotten good advice and they decided to be a sole proprietorship, that $150,000 loss can be utilized in year one and offset other sources of income, maybe a spouse that's a working spouse. So that's the power of stepping back for a second, talking to your advisor and what are my plans, and really kind of modeling it out to make the most informed decision.
Maybe, so we've talked about stock basis on multiple episodes, but we've never really talked about debt basis. Maybe address that a little bit. How's an LLC's basis different?
Well, I think for this purpose, I mean, not to go incredibly technical, that really comes into play when you're talking about partnerships. So maybe you've got two people in a partnership versus a S corporation. In an S corporation, the most important thing I want to communicate is that generating stock basis, it allows you to take those losses. Okay. And when you go out and get a loan from a bank, that loan does not create stock basis for you.
Okay.
Okay. So that's, I think, the most important thing for this purpose of this forum. In a partnership, there are different rules related to basis. Partnerships are much more flexible in that it allows multiple owners to vary the amount of profit or loss they allocate to each other, and even the amount of distributions or draws that they take. So partnership equals flexibility. S corp is much less flexible when you've got multiple owners. And I typically never recommend multiple owners being an S corporation, because it's so rigid.
Got it. Okay, so what I'm hearing then is, if you are a startup, until you start, there's some trigger point when you start generating profit. That's when you switch from a sole proprietorship to an S corp.
I would take it back even one step. I would say, have a conversation with an accountant to help you determine what are the potential upfront deductions, those paper losses that you'll get to take from the beginning in year one. And that will give you an idea of how much profit you have to generate before you exhaust those deductions. And so, it's likely, especially in a brand new startup, you may not be profitable in year one at all. So if you're not profitable in year one at all, you still have those deductions sitting there waiting to be used, to have offset in the future. The other thing is this is somewhat of a blanket advice or blanket comment, but another way of thinking about when is the right time, potentially the right time to be an S corp, or when will it be financially beneficial to me? The S corp comes with rules that in an S corp you can take a wage. It has to be a fair and reasonable wage for your occupation, and you need to take a wage, or dentistry has high wages as it is. It needs to be a wage that at least covers the Social Security wage base limit. And that number changes I don't know what this year's number is, like 100.
176, 180.
Yeah. We pretty much tell people, in dentistry, if you're an S corp, your wage needs to be around 180. Okay. So I tell this doctor this morning, she hasn't closed yet. She hasn't fully purchased it. And I said, you need to prove to yourself that you can take a take-home income over 180,000 before it's probably going to be financially beneficial to be the S corp. Once you're making over that, the more money you make, the more the S corp can potentially save you, but it's primarily saving you on Medicare tax. So the Social Security stops taxing you after the wage limit. So around, let's call it 180. But Medicare is on all profit normally, on all profit, all wages and profit beyond that. And the S corp allows you to not have to take, so it's limited to the wage. Okay, so in an LLC, the entire profit is subject to Social Security and Medicare tax. Social Security still phases out at around the 180, but Medicare tax is on all the profit whether you take it or not. In an S corp, we can limit the Social Security and Medicare tax to the wage only of the owner. Okay, and so the savings becomes the more money you make in the S corp total, the more you can save primarily in Medicare tax, which combined employee and employer side is what, 6%?
15.3 Social Security and Medicare.
Take out the Social Security. I think the Medicare portion is just I want to say it's like 3% in each side, so about 6%. But so we've had clients that have a take-home income $2 million a year. We've got their wage set at like 180 or 200, and everything beyond that can be distribution. In that case, that's it's a very profitable business. It has tax basis. You're able to take distributions against that basis, and that's what the S corp was designed for. What's happening is we're installing it too early on these small businesses that don't have the revenue or the profit yet to make it advantageous.
Yeah, and Mark, there is some, depending on who you talk to, there are people out there that say, oh, well, being a Schedule C increases your audit risk. I really don't think there is a lot of validity to that. Everything they do for audits is all statistical sampling. You and I learned that, or you learned that when we went through that. The IRS has computers too, and they run algorithms, and they're looking at industry standards and looking for outliers. But this is all about education. It's a chance for the doctors to get educated, truly have a conversation with their advisor, and make the best decision for them. And Mark, there are situations where I may say to do the S corp in the first year. It really is fact dependent. Every situation is different.
You might buy an existing practice that already has a really $2 million revenue and a high profit, and S corp from the beginning might make most sense. Also say if somebody is already in an existing practice and they have an S corp and everything's fine, and they're thinking of opening the next location, or they buy another office, that other business has to be looked at the entire picture. If you're already covering your wage through your existing S corp, it may not make sense to make the next one an S corp from day one either. That one might be a sole proprietor or Schedule C. It might remain that way.
Right.
And then the last piece is that, like Brent said, what's the future hold? You can't know for sure, but if you're going to bring in another partner, in partnerships is where the arrangement of taking out unequal amounts out of the business based on whatever you're contributing, that's where it gets kind of hairy. And the S Corp is very limiting in terms of the only way you can differentiate. If you had two 50-50 partners, the only way you can differentiate income is through wages. All the distributions have to be the same. So we've had some scenarios too where associate buy-ins, the existing entity was an S Corp, and we had to go through a discussion of what makes the most long-term sense. It might cost upfront to do a conversion, but potentially, selling the business of the S Corp into a brand new partnership and then having S Corps own that. So there's all kinds of structures that can come into play depending on the scenario. But the key here, the overriding theme is don't just do what you read on the internet. You really need, maybe get more than one opinion. You need a few opinions on the entity and have a discussion around what exactly is about to transpire.
Yeah, and Mark, I would say one of the big trends we're seeing, especially in the last probably 3 years, there is a huge uptick in associate buy-ins.
Yeah.
And these associate buy-ins are typically buying into long-standing existing S corporations.
Okay.
And that is where a lot of the entity restructuring is coming into play. And I think you've probably heard of the term F reorganizations. So that involves attorneys and CPAs. So that's probably the most common thing I see. We probably are seeing 8 or 9 a year, whereas 5 years ago, I saw one every 5 years.
Got it. Okay, so the problem with partnerships, one of the big problems with partnerships in an S corporation, Chris, you alluded to this, is that the distributions have to be equal if it's a 50-50 partnership. So, I mean, we can just very, very quickly see an issue with that, particularly if it's an associate that's buying in, or if you have a situation where you're splitting profit to some degree, and then you are also compensating yourself based on the amount of production that you're producing, right? So then all of a sudden things get hairy. Somebody's producing $50,000 a year, somebody's producing $1.5 million a year. You're in an S Corp, and now you have to split the distributions out evenly, and I can see how that's a problem almost
So yeah,
immediately.
the only way you can differentiate, how you extract income out of there is through wages, and that's the most tax form of income, and that kind of defeats the original purpose of having the S Corp. So Brent and I, we're structured as a partnership. We bought a small firm to get started, but we essentially were thinking of ourselves as a startup. And when we started, it was just Brent as the CPA, and I said, Brent, we need to pay you something for doing the CPA work. I'll go out and find the clients and do the marketing and get us running, and I can get paid later. The only way we can do this and take money out unevenly in the beginning is in a partnership. Now you can make the owners of that partnership an S Corp, which is what we did. So our 50-50 share is Brent's S Corp and my S Corp, and then we can do what we need to do in our own S Corp with wages and
and Mark, the numbers can get really big really quick, especially when you're paying yourself on production. I can think of one of our existing clients, 4 partners, and there is such a varying degree of production. And again, taking into the mindset that distributions have to be pro rata based on ownership.
Yeah.
You've got one partner or shareholder with a $900,000 W-2 because they produce so much more, and the only way to get the money out is through W-2 wages. So you can see how quickly that can become a very large.
Oh, that's devastating. That's 37% on a W-2. Very few things that you can do to offset the W-2 tax liability. That just handcuffs you as a CPA and puts them in a very difficult situation based on.
Well, that and the Medicare tax doesn't stop on that. So you got 3.9% on maybe an extra 700,000 W-2. That adds up.
Ouch. Yeah, that hurts. Okay. So going back to your kind of case study here, Chris, from what you were dealing with this morning, as you were kind of setting the stage, this client of yours did a little bit of preliminary research on chat, kind of tried to do her own LLC, save $1,000 or something, and then went to an attorney, and then the attorney gave legal advice and a little bit of accounting advice as well. So I don't see like something huge that she did wrong. Like she went out and she was responsible enough to get the advice of an attorney. And I think that a lot of people would probably start there, but before an accountant. So what would have been a better kind of choice or priority for her, simultaneously picking a bona fide CPA and a business attorney simultaneously, having them talk amongst themselves so that he could give his legal advice, and then the CPA could give the accountancy advice? What could she have done differently or better?
So again, I think that the legal component is there to protect liability, protect you from lawsuit, and how would things be handled for that entity in your state. And that's the real thing you go to an attorney for, is help me structure this in a legal manner that I'm protected. And they're trying to add some additional value by educating and then saying, I think you should be an S Corp, or I'm an S Corp, so you should be as well. Mm-hmm. So now that's where we're getting into, entity filing, like tax filing status. And it was just blanket generic advice from the attorney. What you should do is, what everyone should consider is, use the professional for what they are the expert in. Mm-hmm. So the legal advice to create the legal entity for protection from liability, and then pair it. Okay, now how am I going to file it for taxes? And the lesson is, you don't have to choose that right away. Mm-hmm. Here's a something to commit to memory on the S Corp. You can file an S Corp retroactively at any point in the calendar year. So you could be in December and file the S Corp election for that calendar year. And that's what I told her. I said, you may not open until April, and you're going to have 7 or 8 months of being in business. We can look at the numbers all along the way and determine if and when it's financially beneficial for you to make that conversion.
Yeah, I think the other lesson, Mark, is this collaboration. I mean, think about how many calls my team has been on with you and your advisors. Mm-hmm. It's all about just connecting the professionals so that they can surround you and make the best decision as a cohesive unit. I think that would be the learning lesson.
Yeah. Yeah. I mean, we talk about this all the time. I talk about it with you, Brent, where you have to be able to assemble your own personal board of directors. You guys are part of my personal board of directors. I have my my tax strategy person. You'd think that, why would I need an additional tax strategist? But there's some exotic tax strategies that I bring to you from time to time. And it's interesting because some of these tax strategists literally are one-trick ponies, or they have like 3 tools in their tool belt, but that's all they do. So they're very good at it. But I wouldn't expect you to know these very exotic tax kind of strategies. But everybody that I am considering doing business with or adopting a strategy, it always goes through you. Like so you are kind of the quarterback when it comes to all things accountancy and tax. Even if you didn't come up with the strategy, you have the team behind you to be able to do the research and see if this is like a good operator, for one, and if it's a bona fide legal tax strategy, and if they're going to execute it correctly, because they need your help as well. And then, you've talked to my attorneys before, you've talked to my my wealth planners before. I mean, it's very, very important not only to assemble this personal board of directors. You got your banker, you got your attorney, you got your CPA, you got your bookkeeper, you got all of your advisors, but they all have to kind of know each other and be able to discuss things with one another. Because if they're siloed, it doesn't matter if they're all sitting in their own individual offices. They just have to have you as a common. You're the kind of you're the center point in the wheel, and everybody has to understand your situation.
And it's no different than dentistry. I mean, think about it. That's why we have general dentists, we have orthos, endos, we have specialists, right? Mm-hmm. So there, like you said, there are certain strategies where there are legitimate experts that is the only thing in their wheelhouse, and why not utilize them? And that's what you and I do together.
Yep. What have you guys seen? This is a huge departure, right turn here, but what have you guys seen with the big beautiful bill? As far as like 179s and bonus depreciation and stuff like that, have people been very aggressive utilizing the bonus depreciation? And you, Brent, have always told me, don't lose 63 cents in order to gain, 37 cents or whatever in a tax deduction. And I think a lot of people buy unnecessary things because they get hyper focused on bonus depreciation or a tax deduction for a 179 or something like that. Have you guys seen a lot of that?
I would say, for the most part, business is normal.
Well, dentistry has just always been very heavy on Section 179.
Right, and bonus.
You get, every year you get the supply rep kind of reminding you of that part of the tax code to buy something.
Yeah, I would say, because I have always educated, you never buy something just for the tax deduction.
Mm-hmm.
The practice must need it. There must be return on investment. And if that's the case, buy it. And then the added benefit is the tax deduction. So I think we had a couple of doctors that maybe slowed down their building projects because we saw the bonus being reinstated. But I don't think on a wide scale there's been any huge uptick or.
I think it's brought back some excitement around on the bonus depreciation on real estate. It's brought back some excitement about doing more real estate for a lot of people. And again, we're huge proponents of owning your own building for your practice. I think that's if you don't own any real estate outside of your personal home, that's one of the first things you should consider owning. And so we have seen some people dive into some projects and expansions. But when it comes to equipment, equipment has always been there. It's always one that, the tax code says, and the equipment rep will remind you that you can write off up to $1 million a year. That's part A of the sentence. But part B, going back to the S Corp example, is you have to have a tax basis to write off against. And a lot of dentistry does not have a tax basis, does not have a positive tax basis. So similar to Brent's earlier example, if the business has a $40,000 tax basis, but you bought a $80,000 cone beam, piece of equipment, you think you're writing off 80,000, but you can only write off 40. That doesn't mean that the other 40 is lost. You just have to carry it over to a future year, generate profit, generate basis to use it again. So that's the thing is be careful about making, shotgun decisions just for tax deduction. That's where everybody ends up kind of getting in trouble.
Yeah. I don't want to go down a rabbit hole because we've talked about this at length before, but cost segregation is an extremely powerful tool, especially nowadays with bonus depreciation. This is one of the things that you helped me with immediately, Brent. I don't know if you remember, but my previous CPA was very uncomfortable with cost segregation analysis. In fact, he claimed to have done his own kind of back of napkin math, and he didn't think that any of my 4 commercial buildings that I owned at the time would be positive in the cost segregation analysis. So he just kind of brushed it aside. As soon as you took over, you're like, have you ever done a cost seg on any of these buildings that you own? And I said, no, my previous CPA said that it wouldn't be worth the effort. And that wiped out basically an entire year of taxes for me in 1 year, which, that was, you and I were best friends right off the bat, because you did that. But and that, of course, that wasn't one of the years that was in question that I got audited for. But it is it's extremely, extremely powerful strategy, especially now with the 100% bonus.
Right. Well, we really became best friends, Mark, when that IRS bill went from 2.3 down to
24,000. 2.3 million to 24,000. That was pretty good.
The story there that we deal with sometimes is we do have some doctors who decided late in life, late in their career, that they wanted to build like their Taj Mahal dental office building.
Yeah. Yep.
Lots and lots of chairs, big, beautiful building. But then they, less than 10 years later, 5 to 10 years later, they've decided they want to sell the practice. And naively, I'm a fan of keeping the building forever, if possible. They may not have the building paid off. They either want to sell the building, or the buyer, as part of kind of the stipulation, they want to buy the practice and the building. So the seller's letting go of the building. They have to remember that if they accelerated all that depreciation, they may have to recapture that depreciation on the sale, which could mean more taxes out of pocket than expected.
How long of a period of time is that usually, Chris?
Well, it depends. Your normal depreciation on the real estate's 39 years. When you accelerate it, you're breaking it down into components that are depreciated over 5, 7, 15, and 39 years. And so again, did you hold the building for 5 years and use up all the 5-year depreciation? It's the longer term stuff that got accelerated that ends up coming back. So the longer you can hold, like if you can hold it for 15 years, then you should be pretty much in the clear.
Yep.
So just be considering that as you're thinking with the end in mind. At what point in your career, at what age might you sell? Will you keep the real estate? Will you have to sell it or want to sell it? And determine if this is the right move for you. So we have some doctors that are selling and the picture's not so rosy after they've paid taxes, paying off the remaining debt. There's not a lot of money in hand.
Yep. That happened to me with one of the 4 buildings that we did a cost seg on. I sold it before, and there's some depreciation recapture. Is that what they call it?
Right.
Yeah.
Correct.
And turns out that happens with airplanes too.
And boats.
And boats. Ask me how I know. Let's talk about cars for a second before I let you guys go. So one of the things that was flagged on my audit was automobile kind of write-offs. That is it 6,000 pounds? A vehicle over 6,000 pounds can qualify as a business write-off.
For the 179.
For the 179, yeah, and that, I mean, kind of a gray area as far as I'm concerned, and I used to be very, very in favor of this strategy until we had to justify and come up with a bunch of documents and stuff like that during the audit. Now I've bought a couple of vehicles that are over that weight threshold, and I haven't even used them as a business deduction. What do you guys think about that? Because I'm sure that's a pretty common question.
I mean, I would say we're not the IRS, and as Chris kind of always jokes with me, it's not an issue until the IRS says it's an issue.
Mm-hmm.
So number one, we as CPAs are not here to tell you what to do.
Mm-hmm.
We're here to interpret the tax code and guide you on what is in the tax code, and also to advise you if we see things that are being looked at more intensely by the IRS. And I can tell you, for the last probably 4 or 5 years, I've seen a lot more audits that focus on vehicles. It's all, everything you do is a risk, right? It's a risk of whether the IRS will look at it. I think this is another situation where you've got to think about the future. So if I have a doctor, like when a doctor talks about buying a vehicle, one of the first things I ask them is, how long are you going to drive that vehicle? So if a doctor were to drive a vehicle for many years, they will most likely get more tax deductions by not trying to be aggressive and writing it off or running it through the business,
Mm-hmm.
because they're going to be able to reimburse themselves income tax free in their W-2.
Mm-hmm.
Through mileage reimbursement.
Mileage reimbursements.
Yep.
Right.
What's that current rate? Like 65 or 68 cents per mile? It's actually, a lot of times we do the math, the mileage reimbursement is the way to go.
Right,
Yeah.
especially over time.
I mean, depending on how far your practices are apart, that could add up very, very quickly.
Right. And theoretically, technically, the vehicle, if you are going to put it in the business, it has to be titled in the business name. The business can't own an asset that it doesn't actually own. You can't reflect it on your books.
That means the loan has to be in the business name. The auto insurance has to be in the business name. Is a little bit more expensive than commercial auto insurance.
So my general stance, Mark, to answer your question, is more times than not, it is better to leave the vehicle in your personal name and then have the dental practice reimburse you based on the IRS business mileage rate on your W-2. The practice gets a tax deduction. You personally on your W-2, it is income tax-free reimbursement.
Got it. Okay.
Less risk, you're still getting the deduction. It's just a matter of timing. And over the course of owning a vehicle, you can usually get more deductions over the long haul.
If that vehicle is not fully wrapped for marketing, the nicer the vehicle, you got to think about, maybe what will the auditor show up in? It'll probably show up in a rental car, but it's not going to be, the nicer the vehicle that they look at, the more they're going to scrutinize it. The one I had this past week, associate of an existing client, we're doing the tax and accounting for the client and the business. We're also helping out some of the associates. The associate is technically misclassified as being paid 1099 because he wants to have his own S Corp, where he essentially wants to run, his own expenses through it. And it's our first time meeting him, and he's basically telling us what he's done up to this point. And he just bought a $150,000 G-Wagon. And so I just had to say, look, that's going to get scrutinized. That's a six-figure vehicle. It's a luxury vehicle. And the question they're going to ask is, how is this business expense, this thing you're claiming as a business expense, how is it ordinary and necessary to your business of dentistry? And he doesn't even technically own a real dental practice. He's just got his own S Corp. So much, it's a high risk. It's all about, again, if you get selected for audit, and what do you have to lose? Are you willing to go through that? Now, I'll speak for Brent and the other CPAs in our firm. When they get uncomfortable, these guys have licenses just like doctors to protect, and they have a career that they've built, and they don't want to lose their license. And if it's super egregious, they reserve the right to say, you know what, I'm not going to sign that tax return because I don't want to put my license at risk. So we had an existing client come to us, schedule an in-person meeting. It was kind of a weird way that he wanted to schedule. I want to talk in private, and he wanted to buy like a $300,000 Bentley and run it through his ortho business. And he's basically scheduled a meeting to have us give it the blessing. And I said, we're not the one that blesses this,
Yeah.
But what I can tell you is when you come to us asking that way, and you want the CPA to put it in there, you're thinking if the CPA will do it, then you'll get off the hook if it'll be okay for audit risk. I go, that the CPA is not the one that's going to get audited. You are.
Yeah.
And but they have the right to say, no, I know this is egregious, and I don't want to put my name on the return.
Yeah, and I think it'd be fair to say, for some of these practices that are 3 or 4 locations where they legitimately have a vehicle that's only for the marketing team, running to referral offices, 100%, it's legitimate. So we're more talking about these one location practices where they're literally driving from their house to work.
I know on this podcast there are plenty of future dental owners that have their own S Corps right now. That this is probably ringing a bell with them.
Yep, for sure. Yeah, the Urus is 7,000 pounds. The G-Wag is over 6. Those very, very nice Raptors that are $120,000. Those are 8,000 pounds. The Range Rover HSC is heavy.
Not like he knows a lot.
I might have been doing the research.
Not that I've ever looked into the weight of these vehicles for whatever reason, but yes. One more thing, you guys. I'm sorry, we're going to go just a couple minutes over. This is something that just popped into my head. So the Augusta rule is this rule that you can rent your house back to the business for 14 days tax free, usual and customary. I guess whatever you could rent it for, in the area. Does that can you do that if you own a second home, or if you own, say, like a short-term rental home? Can you also take advantage of that in multiple locations, or is it just primary residence?
So you can use it on the second home. I've got a doc I can think of that has a beach house on the East Coast, and he does his retreats there every year.
Okay.
For his entire team. And we do it on that house.
But if he was also renting that house out when he wasn't there, does that disqualify it from the Augusta rule?
No. The main thing with the Augusta rule is the other name for the Augusta rule is the 14-day rent rule. Okay. So the first 14 days of rental income received are tax-free. So when you're holding your own business meetings for your own business, you can decide when those 14 days are, and maybe that's the only time it's rented out. But if it's another property, let's say it's like a ski property or something, and it's rented out the majority of the year, you just want to have you can have up to 14 days rental income tax free.
So and Mark, most of these doctors are not going to be doing legitimate meetings more than 14 days a year, not for the broad base of people listening.
Yeah.
So,
I was just
don't overdo it. Don't poke,
Yeah.
don't poke the
Don't
bear
poke
too
the
much.
bear.
Yeah.
if you have a couple different entities, I'm just thinking,
If you're
I don't know.
filing jointly, husband and wife, that's another potentially a way for you to make a case. You could do it on two properties. You're just not if you own 12 properties and you've got one dental practice or two dental practices, you're not going to be able to do 12
28
different
days.
versions, of Augusta rule deduction.
That's why I call the IRS and ask them to come and bless it for you.
Yeah. All right, gentlemen. Well, thank you. These are always like my favorite episodes because I dork out on this stuff, and you guys are so knowledgeable. What's the best way for people to reach out if they're interested in taking advantage of Profi or Phase One? And if they contact you, will you tell them which company is more appropriate for them, Phase One or Profi?
Sure. So if you're an established practice of at least 1.5 million of collections, you feel like you've gotten a tax surprise, you feel like you're becoming more sophisticated, maybe you have assets, real estate, things, other businesses beyond just your one dental practice, maybe you have multiple locations. You're probably the best fit for Profi. You can check out our website at profi2020.com, profi2020.com. You can find us all over social media. But definitely check out our YouTube channel. We've had a huge growth in following in our YouTube channel. We're trying to provide pack a ton of content with a ton of value in that channel. Our other model is phase1dentalcpas.com. If you're a startup practice, or if you're buying your very first practice, if it's any practice that's under $1.5 million, and you feel like you might be cost conscious, or you just want to get a sampling of what the service can be like, you're going to get bank-ready financials delivered every single month to you in any work that we do in both models. The primary difference in Profi 2 is the sophistication of the tax strategies that are necessary, as well as a fractional CFO coaching that's included. And you may not need that if you're a startup or buying your first practice. You may just need to keep clean financials, have somebody to talk to, and learn your business. So check that out at phase1dentalcpas.com.
Awesome.
Great job, Chris.
Well, thanks, gents. Hope to see you guys soon. At the very least, we're going to be seeing each other in the summertime. But you guys know that you're always welcome to come to any of our live events. And hey, guys, I can't endorse these guys highly enough. They've saved my ass more times than I can count, and they're also fun guys to hang out with. So, ladies and gentlemen, Chris Sands and Brent Saunier.